New economic indicators are in, and it appears inflation is under control, but still not at the 2% the Fed is looking for. If you need help navigating your financial future, you can head to wealthion.com/free for a free no obligation financial review. I'm your host, Andrew Brill. Let's see what our experts had to say this week. This week, Speak Up with Anthony Scaramucci featured David Rosenberg of Rosenberg Research. He gave us a post-election look at the current market sentiment. He also analyzed whether or not President Trump can remove the Fed. David also took a look at geopolitics under the Trump administration.
But let me ask you about the market, though. The market's saying tilt up, bullish, bullish, bullish. That's when I hit the slot machine on the morning of November the 6th. That's what I got. I got the rocket ship emoji. Is the market correct?
Well, I would say that whatever the market has embedded in its valuation, whatever it's pricing in, is probably not going to come to fruition. But look, I was saying that before the election. I mean, before the election, you had like a 40 basis point equity risk premium, and now we're down to like 10 basis points. So we've gone from an egregious equity market price bubble to something that is more like flying over the cuckoo's nest. So firstly, congratulations on your portfolio. So your heart was telling you one thing and your wallet was telling you the other thing. So I would say that you were obviously perfectly hedged. But the question is, what is the market really pricing in here? And there's no doubt that there's a lot of things that Donald Trump can do on his own through executive order and more deregulation. Clearly a positive. You could point to the financials were the one sector that was really ripping from the outset. But if the market is pricing in massive tax cuts, and of course we also had the visceral reaction of the bond market to, visions of an $8 trillion incremental debt balloon over the next 4 years. I think both of those have question marks in front of them. And I think that what nobody's talking about is the wide divide between what happened top ballot and what happened down ballot. And I'm not talking about the fact that the Senate flipped moderately towards the Republicans, but as you and I are sitting here talking right now, they're still counting the votes for the House. And the chances are that the Republicans will reclaim their majority in the House, but we're not going to know for sure earliest until probably this same time next week. And the one thing that we know is that when Trump won in November 2016, and even though he didn't win the popular vote like he did this time, the Republicans absolutely smoked the Democrats in the House of Representatives, where the GOP had a 47-seat majority. This time around, no matter what, if they take control once again of the House, it's going to be razor thin. So the question is, how do you explain that? How do you explain a president that beat his rival by 3 percentage points in the national poll, but yet there was not a similar landslide or even something close to that in the House of Representatives? And what it's telling me is that this was not really as much a pro-Trump vote as it was an anti-Harris vote. Like, I'm stunned, Anthony, by the fact that Harris got less of a share of the national vote than Hillary Clinton did. And we know what America mostly thought about Hillary Clinton. It was obvious a very negative vote against her, and I would say also a negative vote against the ongoing leftward-leaning movement within the Democratic Party. So I think that's a big part of it. This was not as much pro-Trump as people think. And I'm not even convinced it's actually a vote for Trump's policies. So what happened is that the market believes it's going to be one-party rule, ruled by this pro-business party called the Republicans. And so what everybody did at the outset was take out the 2016 to 2018 playbook where equities ripped and bonds sold off until we got the split government and the midterms in 2018. Interestingly enough, the peak in Treasury yields in 2018 happened in the November midterms that very same day. So I don't think a lot of people really expected there was going to be a clean sweep. Now, we don't know if there's going to be a clean sweep, but chances are that that's what it's going to be. But the House is not the Senate. The House is a fractious group, and it's replete with fiscal conservatives on both sides of the aisle, including 38 Freedom Caucus members and the Republicans. So people that think, so you're asking me, do I think the market is wrong? I think the market is way premature in expecting that we're going to be seeing, at least when it comes to fiscal policy, the tax cuts that were being promoted during the campaign. I think that is probably not going to happen.
You know, Trump is calling for either ending the Fed, or taking control of the Fed, meaning that the independence of the Fed and its board of governors in terms of setting the interest rates would be controlled by the President of the United States, take it out of the hands of the Federal Reserve Chairman. He's going to do that?
Well, I don't think that he really can, as powerful a man as he is. I think that he would definitely need to have congressional approval. I mean, the Fed, the Federal Reserve Act, is a congressional act. The president, like how he appoints judges, does appoint or nominate the Fed chairman. But the Senate has to confirm it. And so I think that there's a lot of bluster here. I don't think that he's going to be able to replace Powell, and Powell made that very clear at his press conference. I think that what Donald Trump will probably end up doing is using the bully pulpit and his X account to try and pressure the Fed. We saw him do that in the past.
Okay.
But actually interfering directly, creating the shadow Fed, or having his own personal, Fed chairman rivaling the actual Fed chairman, I think that's just pure fantasy. I think the reason he won't do it is because it's going to work against his goals of maintaining financial market stability. That would be a policy prescription of triggering instability. And what we know about financial market instability is that's what leads to recessions. So I'm going to assume that there's a certain degree of rationality and that all the bluster during the campaign is not going to live to fruition. And that includes what he wants to do about the Federal Reserve.
We have a couple of wars going on. We have the Ukrainian war. We have a war between Israel and Hamas. Donald Trump pledges he's going to end that war in 24 hours. What do you think happened? Let's start with the Ukraine war. And then the third piece of this thing, I want to talk about U.S.-China. But let's go Ukraine war, Hamas, Israel, and then U.S.-China relations.
Well, the easy one is that I do believe that he will be able to get a resolution to Russia-Ukraine. And, of course, maybe this is an instance where his relationship with Putin might help foster that. And I don't think any of the two parties are going to be very happy with the resolution, but probably Zelensky is going to be a lot less happy. So there will be territorial concessions, but I do believe that is a strong possibility. It's not, when you're talking about Israel, it's not just Hamas, but it's Hezbollah. You can argue the Houthis, and all lines go back to Tehran. So it's really more about Iran than it is necessarily about Hezbollah and Hamas, which are proxies of Iran. So my comment there is I do believe, compared to Harris, that he's going to give Netanyahu a longer lifeline. I don't think that he's going to expect that the conflict with Hamas, for example, is going to end that quickly until Hamas surrenders, which maybe that never happens. But I think he's going to give Bibi a longer lifeline. I think he'll first settle what's easier, which is Ukraine, Russia. And in terms of China, I don't think Xi is going to be doing anything to get Trump rattled. That's the thing about Trump, is he's not a pacifist, but he's not from the military industrial complex. He's not really a warmonger, but people are scared of him. Nixon was not a warmonger. People were scared of him. He ended the Vietnam War, and the next thing you know, establishes relations with China. And people were scared in 1980. The big knock against Ronald Reagan running against Carter was that he was going to start World War III. You certainly remember that. And he's labeling the Soviet Union the evil empire. And the next thing you know, several years later, we have Perestroika. And then under George H.W. Bush, the Berlin Wall comes down. Well, you couldn't have predicted that in 1980, but people were scared of Nixon. Mm-hmm. And people were scared of Reagan. And I think it's probably a good thing for the rest of the world to be scared of the president of the United States. And so I think that there's a reason why, even though his White House was chaotic, as you full well would know, but who cares about that when in those 4 years the world was relatively more trouble-free, that's for sure, than it's been over the course of the past 4 years. Mm-hmm. To me, what's most important is how he deals with Iran. Iran is the greatest threat. Mm-hmm. China, could you argue China is an economic threat any longer as they continuously deal with their property sector deflation? They're in a structural growth slowdown. This is not the China of 10 or 20 years ago. So I see that as less of a threat, and China's not going to do anything with Taiwan, certainly not with Donald Trump in power. To me, the most important geopolitical risk is what happens with Iran. And the one thing we know about Trump is that he was a lot harder on Iran and the sanctions and so on and so forth. And my hope is that he realizes that this war in the Middle East is just broader than just Gaza and the West Bank and Hezbollah and Lebanon, but it's really about Iran and Islamic Jihad and extreme fundamentalism. So to me, that's going to be the most important geopolitical hot potato that he's going to have to handle. All roads lead to Tehran in the next 4 years from that's a geopolitical aspect.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. Jonathan Wellum of our partner RIA Rocklink joined us this week. It's Jonathan's belief that the debt has reached historic levels and together with inflation remains a grave concern. The government continuing to print money to meet debt obligations is a recipe for disaster. He also disagrees with the Fed's economic outlook and points to labor costs as an indication of persistent inflation.
What's your take on the U.S. economy? Do you have any concerns? Well, the typical concerns you're going to have is that the overall indebtedness of the economy. So the deficit 6% plus of GDP in a time where you actually have economic growth. So this is a big concern. This has been a concern, of course, for quite some time, and so that would be the major concern, just the overall deficit that they're running and the accumulated debt. 35, $36 trillion is a huge number. Now, I'm very much thrilled that Donald Trump was elected vis-a-vis another 4 years of the Democratic regime, which I don't think would have been good for the capital markets. They were talking some of the policies that Kamala Harris was talking about, increasing taxation. In fact, even talking about taxing unrealized capital gains. That would have been just a nightmare if something like that would ever been put in place. So I'm certainly happy that they're going to have a government that's more geared to growth, less regulation, lower energy costs, because they're going to try to open up more drilling and so forth. So I think those are going to be positives, and clearly the market has responded post-election with a little bit more enthusiasm in terms of a much more growth-oriented agenda back in the United States. Having said that, it's going to be, Trump's going to have to be careful. They have a large budget deficit. If he does want to continue to cut taxes, that could cause, again, more problems from a fiscal perspective. So we'll have to see how things emerge. But there's some good people there. There's some good ideas. And I think that's going to put a little bit more pressure on other countries like Canada. It'd be a little harder for Trudeau to continue zapping us with more taxes when our neighbors south of the border are getting tax relief.
So the other big news recently was the Fed, and they cut by another 25 basis points after cutting 50 in September. And Jay Powell said the economy is in great shape, inflation pressures have eased. But I have to be honest, I take issue with anybody who says inflation is under control, because I don't think it is. And we recently saw some economic data out of the U.S. Unit labor cost increased by 1.9% versus expectations of 1.1%. Labor productivity was 2.2% versus expectations of 2.6%. So costs are going up. Labor productivity is going down. It's the same thing that's happening here in Canada, and it's been going on for quite some time. And then when you look at the number of unions that have negotiated some very excessive pay raises, the longshoremen on the West Coast, they got a 32% pay increase. East Coast longshoremen got 60%. But what are your thoughts on what Jay Powell said about inflation and any other comments he said about the economy?
Yeah, I'm skeptical. I hope he's accurate, but we certainly are not betting on it or investing based upon what Jay Powell is saying. We're being very, very careful. I think what you've pointed out, you've got these labor costs going up, unit costs. What we need to do, and hopefully, again, a new administration in the United States will help this. We must free up the private sector to be able to make more things, produce more things, to be more efficient. Again, productivity has to continue to increase. In the United States right now, under the Biden-Harris regime, private sector jobs are practically non-existent. They're very, very weak. It's been the government jobs that have been growing. Same thing here in Canada. And so I'd argue that the economy is weaker than what Jay Powell is suggesting. Certainly much weaker in Canada, but even in the United States, you've got housing prices that have come down. You've got weakness in the job market. People's discretionary income is low. They've been borrowing more money on the credit cards and so forth. So these are all indications of an economy that's under some stress. And of course, that's why I think Powell dropped the rates another 25 basis points. But I think he's maybe not being 100% honest in terms of some of the challenges underneath the surface. But, some of this might be helped by a better government that starts to cut regulations and get costs down. But that, again, will take that's obviously going to take a number of months. That's not going to happen overnight. And so, no, I don't really share Jay Powell's enthusiasm for the overall economy.
So Stanley Druckenmiller recently did an interview. If you haven't seen it, I would suggest everybody check it out. It was a great interview, lots of interesting insights. Anyhow, he thinks one of the biggest threats one of the biggest threats we'll see in 2025 is a reacceleration of inflation. And he actually said this time that we're living through right now, he compared it to the early 1970s, where inflation took off. I think it got up to 8%. Then they were able to pull it back. It got down to 3%, and then it just reignited again, and it went into double digits. And he said there's a threat of that happening in 2025. Any comments on that? Did you see that interview by chance?
I didn't see the interview, but Stan Druckenmiller, as you've pointed out, is exceptional. He's a great thinker, and he's certainly worth listening to. So I'll absolutely listen to that. Yeah, I mean, look, it's all, see, the inflation, or whether it's high or lower, it's going to be a lot of policy. It's going to be policy driven, and that's why it's difficult. So I think if you're taking Stan Druckenmiller's position, if you've got governments continue doing what they're doing, expanding and making it more difficult and pushing green agendas and making energy more expensive and spending more money and so forth, then I think that's all inflationary. But I guess the issue will be, is that what's going to actually happen in 2025? We'll see. Our view, when it comes back to investing, is trying to find businesses that can push on their costs and are a little bit more of an inflation hedge and can protect our investors as best as possible. Because I'm not sure exactly how it's all going to pan out. We'll have to see. I mean, when you look around the world, you look at Europe, it's really low growth, and you've got incredibly mismanaged governments over there. With Germany, France, now you've got Britain, you've got a socialist government there. It's a nightmare. If you look at Japan, again, you've got very little growth out of Japan. China, as you know, has just started to put more stimulus in there, and they're trying to protect themselves again from maybe a more aggressive U.S. policy. And so when you look around the world, there's not a lot of growth and a lot of activity going on. So again, we're just trying to be cautious, careful, making sure that our investments will respond well and be able to continue growing and adding value to our shareholders, our investors.
So you touched on interest rates and bond yields earlier, and the 10-year has ripped from 360 up to 440 in a relatively short period of time. What are your thoughts on that, and why do you think we've seen the yield increase the way it has in the last couple of weeks?
Well, I think, there's probably a couple of reasons. And one reason why we'd be careful about going out the yield curve, and that is just these massive deficits. And I mean, they're huge all around the world. It's not just the US. You've got a lot of deficits. And those have to ultimately be, not only are paying for the deficits, but you also have a lot of debt that's coming due because, if you take the American situation, a lot of their debt is very short term. So you have trillions and trillions of dollars rolling over constantly. If the Fed's not going to pick it up, it's got to go into the market. And the market's looking at this and saying, hey, wait a second, we're not going to absorb this unless we're going to get paid more for it. So I think that's the concern. And with Trump, certainly in the early days, it could lead to larger deficits depending on tax changes and so forth. I think there's some concern that could cause, again, a blowing out of the yields. So I think that's what's getting embedded in the yield curve. I mean, who's going to buy all this stuff? Who's going to absorb all this debt that we've created over the last 20, 30 years? It's insane, the level of debt that's out there. So, and then if the Fed steps in and starts buying it, then we're just printing money, we're depreciating our currency, and we're back to inflation again. So, we're in this bit of a tug of war here, and it's going to be quite interesting to see how it all emerges. It's not going to be easy. Let's put it that way.
And where are you allocating capital now? I know every client is different depending on age and risk tolerance, but maybe you can give us some sectors where you're investing or some specific names.
Yeah, okay. In terms of, we think some of the names, as we're looking at the results that are coming in, some of the infrastructure companies. So we're just looking at the results from Brookfield Infrastructure, and very attractive company, 5.5% dividend yield, trading at a nice multiple, great growth opportunities. So they've got some really interesting opportunities for growth, including their parent company, also Brookfield Corporation, which we think is undervalued. And trading at very attractive prices. We've also continued to invest in. We just had the results yesterday for Burford Capital, and they again are litigation finance, and it's doing very well. Things are going very well in that business. They're really generating a lot of cash. We think that's undervalued, and they also have an opportunity for some large litigation solutions that are coming through. Especially in Argentina, they've got a big one outstanding there. But that's a neat business that'll continue to move along, and it's also trading at very attractive prices. In the technology, we're always trying to look at the technology space because that is a large long-term growth area, and so software companies in particular are great places to be. We've got positions in Autodesk, which is just an incredible business in terms of CAD and be used for engineers and anyone who's doing construction. also Roper Technologies. And we have added, I mean, it's just jumped more recently, but over the last number of months, it's going back a little bit. We will pick away a little bit on Amazon. We think of all of the big guys. We still like Amazon, and it doesn't trade at a ridiculous multiple. And they continue to, grow their business and do amazing things with their AWS and also, their cloud business and also their retail business. So yeah, there's some areas. So infrastructure, financial, technology, just hammering through name after name. A lot of our companies, though, it's very name specific, business specific, in terms of where we invest, and just to continue to ferret out opportunities.
Friend of Wealthion, Adam Johnson, author of the Bullseye Brief and portfolio manager of the Bullseye American Ingenuity Fund, joined us this week. He discussed the economy now under the new president. He also outlined the GDP and what concerns there may be. He also laid out some investment strategies, giving a couple of stock picks and how nuclear power could be one of them. I want to get your take. We have a new president. We have, not unexpectedly, because as James Carville said, I think during the Clinton years, it's the economy stupid. And I think that a lot of people voted with their pocketbook and with how they're actually doing. But I want to get your take on the present economy and where you think it's headed.
Yeah, well, let's start with the economy, because that's ultimately what it boils down to. As you point out, right, James Carville, it's the economy, stupid. GDP is growing. It's growing somewhere between 2.5% and 3%. That's consistent with the long-term average. So that baseline is very positive. We also have very strong employment. There are a lot of people working. Granted, there have been a few more who've been laid off over the past several months, but unemployment is down around 4%. That's extremely low, which is good, because when people are making money, they are spending money. And when they're spending money, that's generating sales for U.S. companies. And that's why we see earnings growth of somewhere between 8 and 10%. And I think actually that's going to accelerate into next year. I think we're going to see 10 to 12% earnings growth. So the macro backdrop is very positive from all the stuff we can actually measure. And then there's the stuff we can't quite measure, like what's happening politically. And very positive in that we now have an administration that is likely to cut taxes, an administration that is likely to cut regulations, and an administration that is likely to unleash drilling on federal land that makes cheaper oil more available. So all that stuff, even though we can't quite quantify it, that's directionally positive. So you add the stuff we can quantify with the stuff we can't quite, but we kind of think we can, and that argues for being long stock. So I'm fully invested. I've done some more buying since the elections, and I think we're going to see a strong run up into year end.
You say that the GDP is growing. Are we worried at all that it's growing at that rate because of government spending?
Okay, so that's a very interesting point, Andrew. There's all this talk about Elon Musk and Vivek Ramaswamy coming in and slashing inefficiency in government. And that will inevitably lower government expenditures. And yes, you're right. Government expenditures are about a quarter of GDP, gross domestic product. So, there is this notion that, hey, wait a minute, if the government stops spending enough, it actually could slow GDP growth. Yes, that is an absolutely fair argument. But I would also argue that that's going to be offset by what I think will be tax cuts. And that means more money for people to spend. And actually 2/3 of GDP is personal consumption. People going out and buying stuff, from cars to houses, clothes, dinners out, insurance, doctors' expenditures, et cetera. So if the government is a quarter of GDP and the consumer is 2/3 of GDP, by definition, the consumer matters more. And I think this administration is very focused on doing what's best for consumers. So yes, you raise a valid point about not wanting to cut government spending too much, but I think there's a far larger offset on the consumer side.
I've asked a bunch of people about nuclear power, which here in the United States, we kind of, because of nuclear waste and all this stuff, I think there's been some massive advancements here. Is nuclear power something we should be keeping an eye on? Look, Microsoft went and bought 3 Mile Island, and
right.
That's not far from where I grew up, and I remember some of the problems that we had there. But is nuclear power something that the United States here in the States will start getting back into?
I think so. I think the answer is yes, that we will start relying more on nuclear power. The thing is, it's a very hard theme, nuclear energy. It's a very hard theme to invest in because these plants take years to permit and then build. So it's not as though you can buy a stock that has exposure to nuclear and say, well, things should kick in by next quarter. I mean, probably not. And you hope by next year or the year after that or the year after that. Now, some of my stocks are long cycle stocks that I intend to own for many years. If I'm right, they will double and triple earnings every few years, and the stocks will, follow higher. But nuclear is a very, very hard theme where you can try to make money. It's a lot easier to make money in oil because there's so many oil stocks. But the irony is that we may be going into a golden age of production, right? If the Trump administration loosens drilling on federal land, there'll be access to more wells. But more access means more supply, which will lower the price. And, that's not necessarily good for the earnings of oil companies. So don't buy, an EOG, the greatest producer out there, or Chevron, I think the best run major, simply because there's going to be more oil production. It might actually hurt them in the long run. What you could do is buy an oil services company like a Halliburton or a Schlumberger, though I prefer Halliburton, because those guys are paid to go in and drill on behalf of the companies that are producing it. So I would bet on service companies, but I wouldn't bet on producers because I do think we'll see lower oil prices, which again is good for consumers, and that's good for the economy and the market as a whole.
And I like your philosophy of taking some money off the table. And again, in the Bullseye Brief, you lay it out for your subscribers. Hey, look, at this price, you should buy a little more. And at this price, you should take a little bit off the table because it may continue to grow, but it may not. So take some off the table, take some profits, maybe take your initial investment out of it and continue to let it ride. So great advice and a great investment strategy.
Yeah, thank you. Well, every person has a different sort of chemical makeup that, causes you to respond differently to, good news and bad news. And, risk is a part of that. So I have clients who have, as a buddy of mine who's a Navy pilot likes to say, no apparent fear of death. And they just want to be long stocks 100% of the time. And if the market trades down, they'll go on margin and borrow more to, buy the dip. I have other clients who say, well, I've made all this money. I don't want to lose it. I still want to grow, but I'd much rather just have most of my money in safe dividend paying stocks or bonds or even government bonds, knowing that, I'm going to earn 4 or 5% per month and it lets me sleep at night. Totally fine. I get it. Most people have a little bit of each of those two sort of inclinations, and that's good too. You want balance. So as I say, we all have different personalities, different chemical makeup, different risk tolerances, and different ways of approaching how we like to manage our money. And the key is knowing who you are as a person, and then finding someone who can help you recognize that vision. Or if you're lucky enough to be able to do it on your own, do it on your own.
Wealthion CEO Stephen Feldman had a talk with Bob Elliot this week. Bob is the CEO and CIO of Unlimited Funds. Bob explained how it's Unlimited Funds' goal to democratize hedge fund strategies by offering low-cost ETFs which are accessible to everyday investors, and how to make use of tax efficiency and AI for hedge fund replications. Bob also talked about long-term portfolio health.
One question jumps off the page. I saw in your bio that you did go to Harvard, but you were not a business major. So, but then you end up in a hedge fund, which is a bit of a stretch for, it says here, a science major and a history major. How does that happen?
Yeah, well, I think there's sort of two things that intersected with each other. The first was, I think, my background in sciences, and I'm a botanist actually by academic training, really brought me to think about the world in sort of, a scientific lens, cause-effect relationships, and particularly in the botanical sciences, thinking about systematics. So how do all the different elements of plant development, for instance, intersect with each other to get the plant that you see, in the ground. So that, I think, was a way of thinking, and that way of thinking, it can apply to the pure sciences, but also can apply to the world around you. And, in many ways, macroeconomy is just the world around you. That intersected with, during my time at Harvard, I spent a lot of time on global public health issues and development issues, particularly around political advocacy. And that was, I sort of learned over time, there's the political realm of what drives, good global public health outcomes. But the reality is a lot of what drives health outcomes is the macroeconomic environment, wealth, access to public health facilities and things like that. And so I sort of increasingly realized that, macroeconomics drives a lot of the things that I was interested in. And so I went to Bridgewater mostly because I was like, they're going to pay me pretty well, and I'll go for like a 2-year paid master's program, and then we'll see what I do. I fell in love with markets and macro, and I'm still doing it today.
Now you have an opportunity. Tell us about unlimited funds, because you just didn't leave, you left for something, right? There had to be a pull, not just a push.
Yeah, and so, when I was at Bridgewater, and also after I left, I spent a little time in the venture side of 2 and 20, and sort of increasingly realized that 2 and 20 managers and strategies, they're good for the managers, they're not great for the investor. And the reason why that is that hedge funds, venture capitalists, they generate pretty good returns, and they also charge very high fees, and they take it for themselves. And that means that the everyday investor isn't necessarily that much better off than they would be on their own. And so that got me to thinking, starting, I guess about 6 years ago, about whether there was a way to bring concepts of diversified low-cost indexing, but bring it to the world of 2 and 20. Obviously, it's totally changed stock and bond investing. But when it comes to hedge fund investments, it's basically today looks the same as it did 40 years ago. It's 2 and 20 managers, highly paid portfolio managers, et cetera. And my co-founder Bruce and I started to think about whether we could take our 5 decades of experience in the hedge fund business, paired with modern technology, modern machine learning approaches, and basically build technology that allows us to see and understand how hedge fund managers are positioned in close to real time, and then take that, package it, translate it into long and short positions and liquid securities, and package it into products that are available to everyone, because we're doing it with technology rather than paying star portfolio managers. We do it at a lot lower cost. And so I in a lot of ways, I'd say I'm a reformed 2 and 20 asset manager. I was on the 2 and 20 asset management side for a long time, and today I'm back in the challenger seat, basically taking on big 2 and 20 managers.
And okay, so let's project out for a second. It's always interesting to me that even for an S&P 500 fund, there are different fees. And if everybody were rational, they would in all likelihood buy Vanguard. It has the lowest fee, or find some Schwab fund that had the lowest fee. So in essence, at a high level, what you're saying is I can give you a hedge fund performance, and I can give it to you at 90 or 95 basis points, and you don't have to have 2 and 20. And by the way, it's probably even more tax efficient.
The tax efficiency for taxable investors is a big deal.
Right, because when, as a hedge fund, and I've been an active hedge fund, private equity investor, I find that what ends up happening is there's a lot of drag for taxes, and there's also a lot of drag for capital calls. So you get your money back, or you need to have it in waiting there for the capital call, so you're making cash returns, and you weren't making, up until a year and a half ago, that was zero. And so you were weighing your 17% return in private equity to the zero that you have making your capital calls. Then you got gains tax, K1s, whatnot. Here you can invest it, wait, decide what you want to do, and you can hold it forever and never pay tax. So long-winded way of saying that it would be very efficient for people, if they can get the same return, to pay 95% tax efficient than 2 and 20 tax inefficient.
Right.
But you have a modest fraction of the funds under management of Bridgewater. What's going to change that?
Well, I think for a lot of folks, they see the world of ETFs, which an ETF is basically a tax loophole. And they see that as low-cost index products, which is right. A lot of the assets under management in the ETF space are still low-cost index products. But there's been basically 2 important shifts that have happened over the course of the last couple of years. One, there was a regulatory change in 2019 and 2020, which no one paid attention to because we were dealing with COVID, that allows active managers to run much more sophisticated strategies in that ETF wrapper. Yes. And that's very interesting because in a lot of ways, the ETF structure is actually most efficient for multi-asset, moderate turnover portfolios by washing away those capital gains. So instead of running it in an SMA or running it in a fund structure, if you run an ETF, basically every time you're shifting the positions in the structure, you don't have to pay incremental short-term capital gains on those positions. And so that's been a big change. And that paired with the fact that there is now a set of white label providers basically building an infrastructure to execute that in a much more efficient way. Basically at Wisdom Tree, which is a $100 billion ETF issuer, Wisdom Tree level costs for funds that are much smaller, those two things are combining together to create a unique opportunity to run these strategies in that ETF wrapper. I think we're early days in terms of investors recognizing the promise, honestly, of active ETF products. Really, it's basically like Cathie Wood's the only one, and she hasn't done all that great.
You need a gain. You need shelter.
That's right. And so I think slowly but surely, when we go out and talk to advisors, when we talk to institutional investors, they're increasingly saying, "Oh, now I see and understand this product, this structure." Is really effective at running these sophisticated asset strategies, and we're starting to get more and more flows. Many more flows are going on a percent growth basis, orders of magnitude higher flows into active ETFs than in passive ETFs.
Listen, I'm going to stop for a second. I'm going to make a public service announcement, and I'm going to expound on something that Bob said and something that I do in my own personal account. The ETF is a tax loophole. So if even back in the old mutual fund days, you were actually getting a statement that gave you your gains and losses from the mutual fund. And if you bought in on a mutual fund on the day before the end of the year, you got the gains and losses from the mutual fund. The ETF can trade within the fund, and you don't get the underlying gains or losses that are in the positions in the ETF. You only get the gain or loss from the time you buy the ETF or you sell the ETF. So, moreover, if you were in a private equity fund or a venture fund or a hedge fund, you have a K1 and you have to manage that. The ETF, you don't get a K1, it's in a 1099. And so the 1099 only comes when you sell. And so you could sit there and you can compound tax-free in an ETF where you can't in a mutual fund and you certainly can't in a private equity. And I'm going to say this with probably controversial, but a good short to make out of this. As a graduate of the merchant bank and doing a lot of private equity investing as the asset manager, there is a real, quote, tax, pun intended, on the system for somebody who's getting the gains managed by the manager versus by your tax lawyer or your tax accountant. So anyway, another reason why these unlimited funds are on an after-tax basis are better than hedge funds is because if you're getting the hedge fund return, you're getting tax efficiency, and you can decide when you're going to pay your tax, as opposed to letting the asset manager decide when you're paying your tax. So how would you position somebody who's high net worth, mass affluent? They've got money they're not trying to pay their credit card bill this month. How should people generally position or at least be tilted today versus where they might have been 4 years ago?
Yeah, well, I mean, it kind of dovetails to the conversation we just had, which is that the first thing I'd say is if you're holding sort of a traditional 60-40 portfolio, and in particular you don't have any gold in your portfolio, there's the one most efficient improvement in your portfolio diversification is moving up to 10% allocation to gold.
What's second?
The second, I'd say, is recognizing that in an environment of overly easy monetary policy, there's really two things to keep in mind. One is it favors stocks and gold relative to bonds. The second is it will likely favor those those companies that have been underperformers. And so it's easy to chase the high-flying, yes, very elevated expectations of those, of the Mag 7 and the equivalent. And I think the challenge is at some point you see the expectations are so elevated that it's very hard to meet them. The types of things that are priced into essentially the AI trade today are incredibly implausible. For instance, the expectation would be that margins would double from here. That's very, very hard to see how that's going to happen over the course of a few years without, the flip side of a margin expansion is actually paying people less. So you can't, it's not magic, right? If you're going to pay people less, then that's got to be made up somehow. Yep. And that's likely not going to happen. And so I think moving away from those high flying stocks and finding other areas of the market that are less loved. So for instance, commodity stocks that are trading at 10x.
Yes.
Right? Those are boring. Those are boring companies. They don't make for good cocktail party conversation, but if you're starting to think about how do I invest in a way that's going to compound wealth over a 5 or 10 year time frame, you're going to do better buying stocks that are, trading at 10x, on healthy margins and decent earnings growth than those that are trading at, 40x with unbelievable expectations.
We added an extra episode this week. Our experts are our experts for a reason. Back in June, our guest Justin Nugent made a prediction that seemed far-fetched for the S&P, but he nailed it this week when the S&P hit 6,000. Take a look.
I have something to say that is going to be unpopular and a little crazy, but flies in the face of what I think every hedge fund on the street is predicting right now, and it is a long-term prediction in the SPY. And spoiler alert, that's going to be my winner for this week.
And explain to us why you think this is going to be the winner. Right now, it's trading in the low 500s, and I know you thought this was going to go to about $600 in the longer term, maybe by the end of the year, which is really only 6 months away. So that's still a pretty nice gain. You're talking about almost a 15% gain on that stock.
Absolutely. I know it sounds crazy.
Thank you for watching this week's recap. If you need help planning your financial future, head over to wealthion.com/free for a free, no obligation financial review. And please follow us on social media. All the links are below in the description. If you haven't done so already, please make sure to like and subscribe to our channel. And don't forget to turn on notifications so you never miss a video. Thanks again for watching. If you like this content and are looking for more ways to keep growing your investments, watch this video next. Until next time, stay informed, be empowered, and may your investments flourish.